Welcome back to EDS, and in this video I'm going to show you how to make money from trading options the right way. This is going to be the opposite of what most people will tell you what to do. We are not going to be buying contracts, we're not going to be buying calls, buying puts. We're going to be taking the other side of the trade and we're going to be selling the calls, selling the puts. Okay, now there's two main customers that we sell to. One are institutions like hedge funds, etc., and two are degenerate gamblers. So either way, we are the house and we have the edge when we are trading in this way. So the first thing you want to do before actually deciding what to sell and where to sell it, you need to find some underlying to trade. So you want to pull up a watch list. I personally like to use futures as much as I can because futures gives you a very nice return on capital. It's very efficient, capital efficient, and the mechanics of it are exactly the same. It basically allows you to have a PM account level margin with just a normal margin account. Because of something called span margin, but you don't need to get too bogged down by that. Just futures that have options available to trade on them. If your broker doesn't display a native watch list with futures that have options available to trade, just copy these tickers, symbols, and make your own custom watch list. You then want to have IV rank on your watch list. It's very important, and you want to order everything from high to low IV or IV rank, and you only want to look at things to trade that have an IV rank of at least 30. Anything under 30, it's not the best scenario for us. I mean, we still have the edge, but we really have the edge over 30, and over 50 is considered to be very high. So I like to be around the mid to high range. We're going to have a look at ZS today. It's got a super high IV rank of 105, 35% IV or implied volatility. When you are looking for something to trade, if you have a smaller account, you probably want to stick to things like soybeans, bonds, currencies, because they don't require as much capital or buying power even. If you have a larger account, feel free to trade anything you like. For example, things like crude oil, they're big products. Well, all of these products are big products, but your buying power requirement is considerably higher on something like crude oil as opposed to corn, for example. So once you've selected your underlying, you want to then pull up a list of expiration dates, option expiration dates for that underlying. And the one you want to pick needs to be between 30 and 60 days out in time. So there's one here, 51 days, April 25th. We're going to open that up, and now we can see the options chain. Okay. So all the initial steps have led us up to this point. Those are very, very important steps. This is going to be the icing on the cake now. So very quickly, for anyone that doesn't know what an options chain is, we have calls on the left, puts on the right. This orange horizontal line shows us where the price of the underlying is with respect to these strikes that are going down the middle. These dotted blue lines show us our 1 and 2 standard deviation levels. And in the top right, we have our implied volatility, which is 20%. And then we have the expected move in parentheses, which is plus or minus 46.06. And that expected move is also visually displayed with this vertical orange bar here. So if your broker platform doesn't show this expected move bar, it's fine. You can just calculate it yourself using the expected move in the parentheses. So what we're going to do now is get into the exact strategy that I use. So once you've got up until this point, done all of your analysis, you want to simply sell one call and one put. Now, when you are buying contracts, you want price to move in the direction of wherever you are selling those contracts. If you're buying a put, you want price to go down. If you're buying a call, you want price to go up. We're going to be selling, so it's the opposite. Okay, so we want price to stay away from our contracts. Now, if we know what the expected move is, we simply just need to sell contracts outside of the expected move, and that's going to give us a high probability of success. Now here's the trick, because the further out you go, the higher your probability of success will be. However, the lower your return will be because you're taking less risk and you're collecting less premium. So a sweet spot, in my opinion, is to be between 15 and 20 deltas on either side. So you want to make sure you have the delta column on your calls and for your puts, and you want to find a a strike that's between 15 and 20 deltas. So as you can see here, there's 0.16, so that's a 16 delta. The 1070 strike, we're going to sell that. And then there's a 16 delta on the put side at the 940 strike, and we are going to sell that. Now, what have we done here? We've created a range for ourselves, and we want price to be within this range, specifically in 51 days time. And if it is within this range, then we are going to make money. We are going to make we're going to keep the premium that we collect up front. So if you were to get filled at this mid price of 11.5, we would collect $575 up front on this position, and we would keep all $575, assuming that the price expired within this range, anywhere between 940 and 1070. Now, what's the likelihood of us making money on this trade? Well, in the bottom left, we have our pop, which is probability of profit, and that's currently just below 70%, 69%. So we've got a 69% chance of making money on this trade, and that's if we hold till expiration. I personally get out at 50% of max profit, and your P50, or probability of hitting 50% of max profit, is gonna be about 10 to 15% higher than your pop. So you're looking at about 80 to 85% chance of hitting 50% of max profit. So our win rate's gonna be, 8.5 trades out of every 10. So very, very high win rate. And so we're going to collect $568 up front, and our broker is going to require just over $2,000 in buying power to open this position. So we're getting over a 25% return in 51 days, which is very high. Now for futures, this is you can get much higher returns. For example, we have a position on corn right now where our return, the exact same setup as this, our return was over 50%. So 25% is okay, but just go through your watch list and you can find higher returns if you really wanted to trade soybeans. 25% is still a very good return. Okay, so that's basically the trade setup, and you need to do this over and over and over again, as many times as you possibly can, to let short-term variance basically become negligible. And you want to have as many occurrences as possible. You want to do it over and over and over again. You want to roll the dice as many times as you can and let the odds work out in your favor. This doesn't even take into account that implied volatility is generally overstated compared to actual volatility, which is going to increase your win rate even further. Now, if you wanted to use less buying power, you can just be more conservative. Say you want to just go to a 5 delta. Now you're only going to collect $156, but your buying power requirement is going to be $800. So you can really play around with it, and you can be super aggressive. You can go to, say, the 33 delta, 31 delta on either side. Now you're going to collect 1.3k. Your buying power is going to be 2.7. But as long as you're sticking to something in and around the 15 to 20 delta mark, you're going to be absolutely fine over the long run. It's a pretty good balance, in my opinion. So at the 19 and 21 deltas on either side here, we've still got a pop of 65%. A P50 is going to be around 80%. We're going to collect just under $750, and our broker is going to require just over 2.1k in buying power. So we're getting very, very nice returns on our capital. And remember, this is not per year, this is in 51 days. So in order to keep your position sizes in check, you need to know how much buying power you should be allocating. And we've created a free position sizing template that's available for everyone to get a copy of. The link is in the description. The way it works is at the top, you just enter in the size of your portfolio. So say if it's 32,500, and then below you then enter in the VIX level, the current VIX level, whatever it is. Say if it was 34.1. And then, as you can see, everything is going to be automatically calculated for you. It's going to tell you exactly how you need to structure your portfolio. It's dynamically calculated, taking into account your portfolio size and the VIX level, which is just a proxy for seeing how much volatility is in the market. When volatility is higher in the market, our edge is higher, so you can be more aggressive, and also the chance of a black swan event is lower, so that's another reason why you can be more aggressive as well. And as long as you're following this, you're going to be absolutely fine, I promise you, over the long run. And if you would like to learn in more detail about what we do and how we do it, the link will be in the description. Click on EDS Premium, get yourself signed up. Inside, you are going to have access to this exact portfolio that I showed you in this video. Well, you didn't see the positions that we have on, but it's this same portfolio. It's a live account, and you get to see all the positions that we place, how we manage risk, how we make adjustments, how we turn losing trades into winning trades, into break-even trades. Most of the time, we don't really need to do much adjusting. The trades just come in pretty effortlessly, but sometimes you do need to make adjustments, and you are going to win 8-9 times out of 10 here, but that 1-2 times out of 10 where you lose, if you can work those trades back to a break even, that's going to massively boost your profitability. You don't have to, you're still going to be profitable without it, but it's just going to turbocharge your returns. So all of that you get access to. There's a full course, so no prior knowledge is required. We're going to go through everything start to finish with you. And it's a private community, so if you're ever stuck, if you have a position on, you don't know what to do, by all means, you can just message me directly and I'll get back to you. I'll respond to everybody inside. There's also other like-minded individuals that are already inside, so you can collaborate and speak together. There's a 100% money back guarantee as well. So if you've been inside for 6 months, you follow the course, you follow some of our trades, if for whatever reason you are not profitable at that point, then we will work with you for free until you are. Or you can just request a full refund. So it's completely risk-free. It's $9.99 a month to join. The price will be increasing. Once you're in, however, the price is locked in for life. So you don't need to worry about price increases once you're inside. You're rewarded for getting in early. The aim of EDS Premium is to teach you the skill. We don't want to keep you dependent on us. We want to teach you the skill, and once you've learned it, no one can ever take it away from you. It's very powerful. You can do this from anywhere in the world, from a laptop. You can do this from a payphone. You can literally trade from a payphone from anywhere in the world. It's a very powerful thing to know. And we aim to get you to that point of where you are self-sufficient within 6 to 12 months. So with that being said, I will see you guys on the inside.